Investing in stocks has proven the easiest and best way for the average investors to build long-term wealth. And it's not just a way to make money by owning companies that gets bigger and more profitable. Dividends are an often overlooked way to build wealth. The stock dividend has the advantage of rewarding shareholders without reducing the company's cash balance, although it can dilute earnings per share. When a company gets to the point that it consistently earns more than management can effectively reinvest in the business. And it's a wise move to set up a dividend policy and give those extra profits back to investors. Hi there, welcome to Investors Game. Today, we're gonna talk about, should you invest in a dividend stock? Don't forget to share this video with family and friends and hit the like button if you haven't done it yet. Now, let's get started. These stock distributions are generally made as fraction paid per existing shares. For example, a company may issue a stock dividend of 5%, which will require it to issue 0.05 shares for every share owned by existing shareholders. So the owner of 100 shares will receive 5 additional shares. But what is a shareholder? A shareholder, also known as a stockholder, is the owner of one or more shares of a corporation capital stocks. In other words, is the investors who hold the stock for a certain period of time. A stock dividend is a distribution of shares to existing shareholders in lieu of cash dividend. This type of dividend may be made when a company wants to reward its investors but doesn't have the spare cash or wants to preserve its cash for other investments. Stock dividends have a tax advantage for the investors. The share dividend, like any other stocks, is not taxed until the investors sell it, unless the company offers the option of taking the dividend as cash or in stock. The amount of dividend transferred between the two accounts depends whether the dividend is a small stock dividend or a large stock dividend. A stock dividend is considered small if the shares issued are less than 25% of the total value of shares outstanding before the dividend. A journal entry for a small stock dividend transfers the market value of the issued shares from retained earnings to pay in capital. And a stock dividend is considered a large stock dividend if the number of shares being issued is greater than 25%. Let's put an example of what I said before. Michael is a shareholder of Home Depot and owns 1,000 shares. The board of directors of Home Depot recently announced a 10% stock dividend, assuming that the current stock price is $10 per share and there are 100,000 total shares outstanding. What's the effect of a 10% stock dividend on Michael's 1,000 shares? Well, first we have to determine the market capitalization, known as a market cap. To get this number, we have to multiply the 100,000 shares by the value of the shares, that is $10 per share. The result is $1 million. That's the market cap. Next, we have to determine how many new shares the stock is gonna issue. To get this number, we multiply all the shares outstanding, that are 100,000 shares, by the dividend yield, that is 10%. The result is 10,000 new shares. Next, we have to determine the value shares outstanding. So we sum the 100,000 shares plus the new 10,000 shares. Now we got a total of 110,000 shares. Now we have to determine how many shares will Michael receive after they pay the dividend. Because Michael had 1,000 shares and Home Depot will issue 10% more of the shares outstanding, so we divide 100,000 shares between the 10,000 shares that Michael had. The result is that Michael will receive 100 shares more. That means he owns 1% of the total shares. Now we have to determine the price per share of Home Depot after they give the dividend to the stockholder. A stock dividend doesn't increase the market capitalization of a company. The market capitalization of Home Depot remains $1 million with 110,000 shares outstanding. Between all the outstanding shares that are 110,000 shares, the stock price of Home Depot will be $9.09 per share. But how did we get this number? Well, we divide the market cap, the $1 million, between the 110,000 shares. The result is $9.09 per share. Another simple way to get how many shares you will get is multiply the shares that Michael owns, that are 1,000 shares, by the 10% that is the dividend yield that Home Depot will give. The result is 100 new shares. Now we sum the new shares between the shares that Michael had. Now, Michael owns 1,100 new shares of Home Depot. The next diagram illustrates the impact of a stock dividend on Michael. Now let's see what happens if Home Depot will issue more shares and how this will affect the stock price. The key takeaway from our example is that a stock dividend doesn't affect the total value of the shares that each shareholder holds in a company. As the number of shares increases, the price per share decreases, because the market capitalization must remain the same. So practically you own the same amount of money before receiving the dividend yield, but you own more shares of the company. If the stock price increases, your money will increase as well. Also, a high dividend yield not always is a good investment. The biggest misconception of a dividend stock is that a high yield is always a good thing. Many dividend investors simply choose a collection of the highest dividend paying stocks and hope for the best. For a number of reasons, this is not always a good idea. For example, take a look at Share Dividend's weekly list of monthly dividend paying stocks. When you screen this list by companies with the highest dividend yield, the top names are not always the top performers on the total return basis. On 2019, Corpus Entertainment is the top dividend yield company, with a dividend yield of 26.9%. However, it has a 10-year annualized total return of minus 1.81%, and that's very low for 10 years, and a 3-year annualized total return is minus 18.64%. So while it had the best dividend yield, its total return was not that impressive. Remember, when the stock give you the dividend yield, they aren't give you money. They are issue more shares of the stock, but the market cap is the same, and the stock price tends to drop. Many dividend stocks are safe and have produced dividend annually for over 25 years. But there are also many companies emerging into the dividend space that can be a great to identify when they start to breaking in, as it can be a sign that their business are strong or substantially stabilizing for the long term, making them great portfolio additions. Now that we understand how do we get our dividend, there are also some advantages investing in the dividend stocks. Number 1, maintaining cash position. A company that doesn't have enough cash may choose to pay a stock dividend in lieu of a cash dividend. In other words, a cash dividend allows a company to maintain its current cash position. Number 2, tax consideration for a stock dividend. No tax consideration exists for issuing a stock dividend. For this reason, shareholders typically believe that a stock dividend is superior to a cash dividend. A cash dividend is treated as an income in the year received and is therefore taxed. Number 3, double your profits. If the stock that you invest goes up by 30% in the next 3 years, and you receive a dividend yield of 3% per year from the same stock, the combined profits are way higher than just the capital appreciation. Here, you can earn double profits compared to investing in companies that don't give any dividends. Number 4, maintaining an investable price range. As you noted before, a stock dividend increases the number of shares while also decreases the share price. By lowering the share price through a stock dividend, a company's stocks may be more affordable to the public. For example, consider an investor with $1,000 looking to invest in stock A or stock B. Stock A is priced at $2,000 while stock B is priced at $500. Stock A will be deemed unaffordable for the investor since he only has $1,000 to invest. Also, there are some disadvantages investing in the dividend stock that you should understand before investing real money into the market. Number 1, market signaling and asymmetric information. The market may perceive a stock dividend as a shortage of cash, signaling financial problems. Market participants may believe the company is financially distressed. As they don't know the actual reason for the management issuing a stock dividend, this can put selling pressure on the stock and depress its price. Number 2, risky projects. Issuing a stock dividend instead of a cash dividend may signal that the company is using its cash to invest in risky projects. The practice can cast doubt on the company's management and subsequently depress its stock price. Number 3, dividend cut. This is the worst case scenario. Dividends are not obligation and the company may decide to cut the dividends anytime in the future. Moreover, when the company cuts the dividends, even the share price falls significantly as the public seems it has a negative sign. And that's why the dividend investors may face double-sided trouble. Now that you have understood the pros and cons of a dividend investing, the next big question is, when should you exit a dividend stock? If you invest in a dividend stock, look for the following signs periodically to avoid any dividend pitfall in your invested company. Here are the 3 signals that you should exit a dividend stock. Number 1, dividend start declining. A fall in dividend for a year compared to a previous one can be ignored by the investor as business can always have a few losses in some years. However, if the dividend start continually decline year after year, it might be a sign for the investors to exit. Next, high dividend payout. A payout ratio greater than 70% for the continuous year may be a warning sign that the company is not retaining enough profit for its growth. Next, an adverse change in dividend payout policy. If the company changes its dividend policy against the favor of the investors, then again it might be a sign to exit that stock. If you like this video, don't forget to hit If you like this video, don't forget to hit the like button. Let me know in the comment box, would you invest in a dividend stock? Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.